So what if I told you that the stock market gains you've been counting on, the ones that are supposed to make you rich for retirement, what if they're just a mirage? And look, this isn't some crazy conspiracy theory. This comes from a finance professor with over 20 years in the game. And what he figured out, well, it might just change how you see your investments forever.
Just listen to this quote. I still didn't get it until I'm age 58. I mean, think about that for a second. That is a huge admission. It just makes you wonder two things, right? First, who on earth is saying this? And second, what is the it that took them almost 60 years to finally understand?
Okay, so the person behind that quote, well, he's not just some random guy on the internet. Get this, he's a finance professor at NYU's Stern School of Business. We're talking one of the top business schools in the world. For more than 20 years, he's been the one teaching the future titans of Wall Street, which, makes his confession, and whatever it is he missed for so long, that much more incredible.
All right, so let's dive right in. This is an expert's confession. We're going to find out what on earth this massive insight is, something that could hide in plain sight for decades, even from a guy who taught this stuff for a living.
I mean, just let this sink in for a minute. We're talking over 20 years of teaching finance at a top-tier school. More than 1,000 students have gone through his classes. So if a concept this big, this fundamental, managed to fly under his radar for that long, well, it's pretty clear we're not talking about some simple little market trick, right? This has to be something deep, something structural about our entire financial system that's just hiding right there in front of us.
So what's the big secret? What's the it he didn't get? Well, it turns out it all comes down to connecting two really important numbers. Two numbers that, most of the time, we look at completely separately.
Okay, so the first number, it has to do with a phrase I'm sure you've heard a ton lately. The money printer. Money printer go burr and all that. It's really just a catchy way of talking about something called monetary expansion, basically the creation of new money.
So if you look at the big picture, across major economies over the last, say, few decades, the money supply grows by about 8 to 10% a year, on average. Now, this is the really important part. When you print more money or just create it digitally, every single dollar that's already out there becomes a little less valuable. It's like a quiet, invisible tax or a constant headwind that's always blowing against your savings.
All right, that's number one. Now for the second number. This one is something you definitely know. It's the big one. The benchmark we all use to see how we're doing in the market, the S&P 500.
Yeah, so historically, if you look way back and you include reinvested dividends, the S&P 500 has returned around 9.7% per year. That's the number, right? That's the one we all chase. It's the engine of growth that we're all told is going to build our wealth and get us to a comfortable retirement.
So now we have these two huge opposing forces, right? On one side, we have our money being devalued by, let's call it 9% a year. And on the other side, we have the market growing by about 9.7%. So, what happens when we finally put them together? This is where we get to the professor's big aha moment.
So, let's ask the question directly. What happens when you combine them? When these two powerful forces, one pulling you down, one pulling you up, finally meet?
And wow, here it is, laid out plain and simple. You start with that awesome 9.7% gain from the S&P 500. That's the number that makes you feel great when you look at your statement. But then you have to subtract that quiet 9% hit from monetary expansion. And what are you left with? Your real wealth gain. Your actual honest-to-goodness increase in buying power is a tiny 0.7%. After all that time, all that risk, you're basically just running in place.
Here's how the professor put it, and it's a pretty stark way to say it. The entire value of the S&P 500 is equivalent to the money printer. Just think about that. All that work, all that innovation, all the profit from America's 500 biggest companies basically just adds up to canceling out the devaluation of the dollar. It's a wash.
So here it is. This is the big startling insight. The main job of the S&P 500 for most people isn't really to create new wealth for you. It's not about making you richer. Its primary job is to be a shield. It's a life raft, just trying to keep your capital afloat while the tide of new money rises all around you.
And when you understand that, well, it forces you to completely redefine what it even means to gain value in the first place.
This really puts it all into perspective, doesn't it? On the left, that's what we think is happening. We think we're gaining value, building wealth, getting richer. But the reality, on the right, might be something totally different. Gaining value is really just keeping you even. Building wealth is actually more like treading water. And getting richer? Maybe that's just a desperate attempt to prevent yourself from getting poorer. Suddenly, investing isn't about offense anymore. It's all about defense. And this is the phrase from the professor that just sums the whole thing up. It's a total paradigm shift. The things that appear to be gaining value are not gaining value. They're just keeping you even.
And that leads us to the really big final question, doesn't it? If just owning the whole market is basically a strategy for standing still, just protecting what you already have from being inflated away, then how does anybody actually get ahead? How do you generate real wealth that beats this constant, invisible drag on your money? That is the massive question this whole realization leaves us to think about.